did one of those e-newsletters last week, and actually it was very similar to what we're going to talk about in this segment. But if you want to get signed up for our e-newsletter, we send those out in the middle and the end of the month. Just go to our website, northwestquadrantwealth.com, and the little box will pop up, and you can put your info in there, and we'll send that. And that's all we send, mostly because we're too lazy to send anything else. If you want to take us up on a free retirement review anywhere you can hear this show, call our office to get that scheduled. That number is 800-743-0988, or you can always go to our website, northwestquadrantwealth.com. Send us an email and just let us know you'd like a free hour of our time. This comes from the Treasury Department, and this one, I'm sure you talked about this last week, but that doesn't mean I don't want to talk about it this week. The CARES Act included $454 billion given to the Treasury Department to provide a backstop up to $4.5 trillion of Fed loans made on up to $4.5 million. Let me start over. The CARES Act included $454 billion given to the Treasury Department to provide a backstop on up to $4.5 trillion of Fed loans made to big businesses. Treasury Secretary Steve Mnuchin reported that only $25 billion of the $454 billion had been used by the Fed in making loans, and the unused $430 billion should be returned to the Treasury Department. Mnuchin recommended that 5 emergency lending facilities that opened in March of this year should be shut down at the end of the year, although he did concede that the 5 programs could be reopened. That's important for people to remember in the future if needed. And man, oh man, Congress went after him like he, was asking for their kidney. I mean, he was just doing something that made total sense. The lending program could be reopened, and it's not like we couldn't have another CARES Act to take care of it.
But there was political underpinnings in that.
I understand.
And that money could have actually been reallocated by the incoming administration without any say from Congress. And
I understand the political.
That's why it was done.
But I mean, we need some level of fiscal. I mean, come on. There needs to be some fiscal discipline. And if I am the last administration, I mean, I'm not advocating for either one here, but I would say, look, I want them to have their own deal that they have to deal with.
Now that we're coalescing around a deal, almost, essentially 2 weeks to the day after that action was undertaken, I'm just wondering to what degree that actually forced the hand of the speaker.
Right.
She sort of had an ace in the hole, and
knowing that money would be available.
Knowing that there's $500 billion sitting there unauthorized that they could just be reallocated.
But these lending facilities can be reopened. It's not like it's. I mean, I don't know. The idea that somebody maybe is going to be fiscally conservative ever in this country is something that I should.
It'll be interesting to see if Senate Republicans rediscover their fiscal conservatism genes.
Oh, I'm sure they will now that there's a Democrat in the White House.
Yeah.
I mean, let's hope so. I hope somebody does. Before we talk about the everything bubble, I thought I would remind people that it is that time of year. If you own actively managed mutual funds, which a lot of you do, either because you bought them yourself or a so-called advisor sold them to you, it's that time of year this week and next. They're paying out capital gains distributions, realized capital gains distributions. So as a mutual fund manager manages their fund, they are buying and selling stocks, and there's a good chance this year that they have realized gains. And guess what? They have to distribute those to shareholders, and that means you, and that is taxed as dividend income or capital gain, some of it long, some of it short, depending on what they have. So reminder that it's this time of year. So if you should be looking. Morningstar does a good job of giving you exposure in mutual funds, your potential exposure to capital gains. So what you should be doing if you have those in your actively managed funds is to be going in your taxable accounts and looking for losses, probably in the energy sector or in REITs that you could sell to offset those gains.
And if you're about to buy a actively managed mutual fund in a taxable account, go look and see what the projected distributions are going to be.
Well, first, don't do it.
Yeah, most of them have already been published, and a lot of the large cap growth funds out there are going to be handing down double-digit gains just in line with last year.
So when I was sitting on the beach last week, I got an email from Josh that sounded a little bit worried in that he's quite worried, rightfully so, by the behavior by many of his peers, and Josh is a millennial, thinking they're all the next Jim Simons from Renaissance Capital, Warren Buffett, right? We have all of this new, and your generation really just has found stock trading, right, with Robinhood and all that stuff.
Well, and they actually have money.
I mean, this is the generation that graduated from college during the financial crisis, so it's taken them quite some time to get started. Now they have some disposable income, and now they're trading stocks. And so we're starting to see some of the same stuff, and actually even worse than we saw in the late 90s. So I remember Josh made a great analogy last week about the guy who started Sun Microsystems, Scott McNealy, who said that if you were buying my stock at 60 times revenue, or
100 times,
100 times, your chances of making money in the future are zero. And guess what? He was right. But we now have companies that are trading at 100, 200, 300 times.
Snowflake as of Friday.
Times sales.
600 times revenues.
Revenues, which means, revenues and earnings are different things. And so the stuff we're seeing right now, and what we want to caution a lot of you out there is you think you now have this, you think this is go on indefinitely, that these stocks are going to go up indefinitely, that somehow the laws of investing are going to be suspended, and this time it's different. But we know that those are the most expensive rules in investing. I am here to tell you that all of you out there listening right now, you think you're going to beat the market, and I promise you, statistically, 99.9% of you are not going to beat the S&P 500 over your investing lifetime.
When you were gone, a couple of texts that were unsolicited texts from friends of mine that had bought a specific Peter Thiel-backed data analytics firm based in San Jose, which is up 300% since its IPO. And, when you think about what they're actually going to potentially earn in 2 years, there's no path to profitability for a decade. And so ultimately that means either they're going to have to turn to the debt markets and increase the precariousness of their balance sheet, or they have to issue more equity and dilute you as a shareholder. Either way,
But none of this math is being done by these people. They don't even know what these companies they're buying do.
To sort of portend what we'll talk about, Burton Malkiel, who we'll talk about later, he talks about the castle in the sky. And many people are buying equities simply with the belief that someone stupid enough will come along and pay more for it later.
Yeah, I mean,
that's a castle in the sky that you're hoping to buy.
We're seeing equity inflows into mutual funds and ETFs, record numbers in the month of November. The poster child for all this, Elon Musk is now the second richest person on the planet. He's now worth $128 billion, second only Jeff Bezos. He's now richer than Bill Gates, who founded Microsoft. Think about what Microsoft is in every
and Tesla
office.
has a greater market cap than Berkshire Hathaway, which has $30 billion in free cash flow, and Tesla doesn't have any free cash flow.
Well, they don't even make money. I mean, yeah, so Tesla's now the sixth largest company in the United States, and without the credits they get, selling the credits from the government, they would not make money. And so, I've never seen anything like Tesla. I don't think anybody has to see the extent. And we're going to talk later in the show about the analysts upgrading it after it's up as much as it is. I mean, Wall Street is also encouraging this reckless behavior, and so we don't think you should be part of it. Be careful is the operative statement. All right, if you want to be part of the show, give us a call, 877-670-7117, or you can always go to our website, financialfocusradio.com, and send us an email. When we come back, we're going to take some phone calls and some emails, so stick around.
Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Northwest Quadrant Wealth Management, a registered investment advisor and separate entity from LPL Financial.